Hello, everyone, and welcome to another episode of the Financial Advisors Want to Know podcast. I'm Catherine Tindall, and on today's episode, I have with me Christopher Holtby. Christopher is a co-founder of Wealth Advisors Trust Company. It's an administrative custodian-neutral trust company based in South Dakota. He began his career as a financial analyst at May department stores, and in his 25 years in the financial industry, we had met a couple months ago, I think. And I got to hear the whole journey about how you guys started in the middle of the financial crisis and just what you've done to bootstrap this company into what it is now. So I want to thank you, Christopher, for joining me today.
You bet.
So we got connected because I was really intrigued with what you guys are doing for trustee services, specifically for advisors, because a core thing that my eyes were opened to was the fact that you've got a lot of cash where the banks are holding, basically that could be under management, but aren't. And I think for RIAs and firms out there, I'd love to just get a quick sketch of what the work that you guys do is, and particularly how that's benefiting advisors trying to grow their firms.
So at a really high level, trust companies only do four things. They onboard a trust, they make distributions, they sign a tax return, and they do investments. We don't manage investments, we don't custody. So we only do 3 out of the 4. What's interesting is advisors don't realize that if they partner with or collaborate with a trust company like ours, they can grow revenue in 3 different ways: finding new assets, retaining AUM, and taking orphaned accounts away from a client that may be using some local trust company, and the advisor is only managing part of it. But it begins with this simple statement. Any advisor can take irrevocable trust business away from bank trust departments because they work with or partner with an advisor-friendly trust company. And the scale of the opportunity is about $4.5 trillion as of the end of 2022 on the FDIC website. So, Catherine, that's what it comes down to. Advisors can be ahead of the curve or they can react to the curve. The curve is coming.
Yeah, because I think for a lot of advisors, you already are the trusted person serving. And so for you to retain more control over what's going on, to actually have an integrated plan of what's going on with those trust assets, in addition to everything else in that family's life, is a huge value add. So for advisors who are interested in pursuing this and say they don't have any resource for this to start off with, where do they start? Like, how do they start to approach working with somebody to do this? Or, what questions should they be asking in terms of getting started with trying to transition into more of this kind of a model?
So the first step 1 is separate your book between qualified and non-qualified assets. The non-qualified side, anyone who is north of 2 to 3 million, north of 60, they need to look at their clients' wills or revocable trusts and see who are the successor trustee. If it's a friend or family member, make sure that they're a client or that they have a relationship with them. If it's a competing trust company, get that changed so that the advisor doesn't get fired inadvertently when the client passes away. That is like meat and potatoes, first thing you have to do. And that should take, on a normal advisor managing less than $1 billion, that should probably be 3 months worth of work. And when you're reading your client's wills or revocable trust, press Control F, type in successor, and it'll take you right to where you need to go inside the document.
Perfect.
Super easy. And when they talk to their client, don't start with a change. Say, are you sure you want the trust distributions to be the way they're written? Like, do they match the philosophy of your money and family? And what advisors forget is their superpower is not on what's the difference between a slat and a grad. That's irrelevant. That's a lawyer's problem. Their superpower is getting clients to really hone in on the philosophy of their money and family and how this is going to look with what their legacy is defined. Mm-hmm. And a lot of advisors think that they have to know everything when they talk to an attorney. Their clients just want them to be the director or the quarterback. Think of us as a tight end. We have a piece to play. The attorneys, the CPAs, in a actor play sort of concept, they're just the writers.
Yeah.
But the one director is the advisor.
Yeah, no, and that's a really great frame because I see a lot of advisors get intimidated by these kinds of setups. Like I see it very common on the tax side too, that they'll get intimidated on the tax side. And it's just, you don't have to understand it. Like you really don't. Like you need to just know where in the cadence things need to flow, and also making sure that you've got the right seats on the bus. But other than that, let the people who have the expertise drive their parts, but making sure that it is cohesively coming together on that plan so that you're that one like true point person for the client. So what have you seen some common issues when it comes to advisors trying to implement this into their practices? Like, are there common sticking spots or roadblocks that advisors tend to hit when they're trying to start to do more of this comprehensive work? Are there common issues you encounter?
So a lot of them really use this as a business tool. So they really start with retaining AUM. That's where they spend the first 3 or 4 months going through their book of business. And even if you're dealing with, firms of the 1 to 10 billion, there's a $12 billion firm. That's where they're going to spend the next year doing nothing but this. Because advisors work so hard attracting assets. Why would you just let them dribble out the back door? So I would say that is the number one issue they should focus on. The next thing that they should do, or the opportunity, is finding new assets. So right now, every advisor has on average 2 to 7 estate attorneys that they work with their clients. Mm-hmm. Those estate attorneys don't know the advisor can work with a corporate trustee in a collaborative relationship, like using someone like us. Mm-hmm. So what you want the attorney to know is, when I have a client who's unhappy using a current bank trust department on an irrevocable trust, think of Catherine, the financial advisor. I mean, you're not, but let's say you were. They're going to think of Catherine and not just another bank.
Yeah.
And so you're really broadening the opportunity set for the attorney. And there's a great story about an advisor in a small town in Wyoming who did this, and they eventually landed a $14 million trust. They talked to the attorneys for a couple of years, and the attorney had finally remembered, oh yeah, I have this extra option. Mm-hmm. And came off to a bake-off and whatever. We won together. I mean, and me and the advisor, we work collaboratively. Look, at the end of the day, we are a tool for advisors. There's $4.5 trillion sitting out there as another 50 or 60 moving down the train. And most of those are going to be using individual trustees. And when those trustees who really have no idea what they're doing, when they want to resign, they're going to go to an attorney. The attorney's going to recommend a corporate trustee.
Yep.
And you know how it goes, right? So it's not that complicated.
Yeah. So I love that, of just that reverse engineering of, once you have a relationship like this implemented, going back and thinking through like that life cycle of, okay, where is this asset going to be finding me? And like, where is the center of influence that I really should be paying attention to? And approaching those estate attorneys so that you're that go-to point person. And, because I think for a lot of advisors, your ability to distinguish especially if you have like a slight niche in any direction, or if you're like geographically centered in one area, it's like people rather do business with people. Like that's just how we are. Like that's how we're wired. And for you to be able to get that relationship in with the estate attorneys and then prove your mettle by, you've helped through the planning process preemptively with clients with them, and they know and get to know, like, and trust you, then being able to extend that and say, hey, did you know that we also do this? That's a really great strategy. What are some besides the landing the $14 million trust? I always like to talk about wins and things that you've seen from stories of people able to actually implement this. Like, what kind of benefit in a normal advisor's practice could they expect to see from implementing, going after this kind of a technique for growth?
So if you take a normal advisor and he's managing 50 to 300 million, right? And if he's part or she is part of a bigger firm, mm-hmm. A normal advisor is running somewhere between 50 to 300 million. Mm-hmm. It makes the first demarcation line is what's qualified versus non-qualified. And so I guess to your question, what does it look like? Do you want to grow business and do you want to retain business? And I literally start with that question. Because if they don't buy in to wanting to retain business, which means they've got to go through these extra steps, I'm giving them water and they have no interest in drinking. Mm-hmm. And no difference if they don't want to grow their business. And again, there is no right or wrong. So the advisors that are most receptive want to grow, mm-hmm. or don't want to get fired when clients die. And advisors are always looking for a Goldilocks solution, not too hot, not too cold. They do it with their custodians. They do it with their broker dealers. They do it with their software. If you're going to use trustee services, you need to find someone who gets them. And we all used to be advisors. So actually, we started out helping some buddies of ours, and it worked so well. We expanded nationally. So, we're 3-ish billion, 15 years later, but it starts with the basics.
Mm-hmm. Yeah, that's great. So for advisors who, have determined that that's what they want to do, they want to grow. We talked a little bit about how you tactically handle that in the conversations with the clients. In terms of like ongoing support, when you go to implement this into your practice, like how much touch time is involved with dealing with this kind of separate class of assets that you're now having to manage and deal with? Like, is it really that much of a lift to get everything integrated? Like, how does that usually work for practices? Hey there, Catherine here. Thanks for listening to the conversation. Just wanted to explain a little more about what we do. So I'm a CPA here with Dominion. We're a tax firm that works specifically for financial advisors as they're growing and scaling their practices to help them avoid tax waste, make the right calls, and grow practices that they love. So if you're interested in saving more, you can DM me on LinkedIn with the word guide, and I'll send you over our guide for financial advisors to scale tax efficiently. All my top tips to unlock 6-figure savings. Thanks, and keep enjoying the show.
So advisors look at everything in terms of asset location. So you've got qualified money, you've got non-qualified money, you could have trust assets. And from a management of investments, it's all tied into the overall financial plan. So really the advisors are just slotting in a different asset location of how that beneficiary is going to have their pool of assets managed. And it could be a third, it could be half, or it could be 100%. So it's really not a big lift. It just flows in seamlessly. What we do, well, forget us. What the advisor needs to make sure, no matter which trust company they use, is that the trust distributions tie into their financial plan for that client. Really, really important, because you don't want the client to be confused. Wait, who's the thought leader for me? And so you want to make sure that whatever trust company they use, the advisor is seen as the thought leader. Mm-hmm. And the technical side is the trust language says how the trustee can distribute money, but only the advisor knows what's the overall financial plan. And so you want to make sure you work with a trust company that gets that. So that's probably, some of the more mechanics. Another little trick is you want to make sure no trust company holds money for fees or distributions in some separate account, because that creates havoc for them in their overall reporting, right? Where they're using Adapar, Orion, Tamarack, whatever, Black Diamond, whatever they're using. And you also want to make sure that the advisor can use their SL master number at Schwab or G number at Fidelity. Super, super important, because that ties into all of their trading, deducting their fees. It's a normal flow within their compliance and operation processes.
Yeah, that's great. No, I love getting into like the technical level of like, you need to make sure these numbers are here and that you're actually getting things credited onto the account correctly. Because, that on the operations side, if you have any pieces that are manual, it's just, it's really brutal.
And it makes your life harder too, Catherine.
Mm-hmm. Oh yeah. So what are some, people who are implementing this, like you said, it's that ability to field new assets. It gives you that really bumped up ability to really, leverage those COI relationships with estate attorneys. You get to retain the assets longer. The management of them isn't that big of a deal because it's just a different location. Once you've got all the, the codes and everything plugged in, it's not that big of a deal. Any other like hidden pitfalls that you see people get into around like communication to clients or operationally or things like that maybe they might not be aware of when they're considering really like implementing this into a practice?
So there's a big one. There's 7 states that have great trust laws, and we can thank our founding fathers that states get to be capitalistic around adopting great trust laws. And geographically, they're Tennessee, Delaware, New Hampshire, South Dakota, Wyoming, Nevada, Alaska. Any one of those states, the advisor is going to be in a great spot. We're in South Dakota. For all intents and purposes, they're almost identical. So most importantly, choose a trust company in one of those states. Make sure, some of the things that we talked about in the past is in there, but also ask them, what else do you do about being custodian neutral and not competing against you, right? Because that's a commodity. If they're custodian neutral, they don't do the tax return, they sign it like we do, they don't manage money, that's a commodity. So what they do is table stakes. The value add is the why and the how, which we've sort of covered. And ask them how they train their trust officers to understand advisors. Because most trust officers don't understand advisors. I mean, it's almost like a lion looking at a mouse. Like, I'm not so sure what to do with this. Do I eat it? Do I not eat it? They don't know what to do. So you want to make sure that these people really, really understand the communication process. Schwab and Fidelity have trust companies within their purview, and they do it because they have to, but it's not their thing. There's really about 30, 20-ish independent trust companies that really do this all day, every day. And then there's another 20 or 30 independent banks that offer it as a side gig. I would lean more towards the independent custodian neutral trust companies. And that's what I would look at.
Yeah, no, that's all great advice. So as we wrap up, where are people able to get in touch with you, Christopher? What's, to get resources, learn more about what you guys are doing? What's the best ways for people to learn more?
I think the easiest thing is reach out to you. Look me up on LinkedIn. That's probably the easiest way to do it. You could do different searches, like search for advisor-friendly trust company. But more importantly, they need to remember companies like ours were a tool. And you don't need us every day, but like a dentist, you want to have a dentist on speed dial. So if it's, Christmas Eve, they're going to answer your phone. And you want to do it ahead of time. And that's really it. It's not complicated.
Yeah, no, that's great. So for people who are interested, there'll be links floating around wherever you encountered this for how to get in touch with Christopher and like his LinkedIn profile. And any closing thoughts that you have to share before we sign off?
No, just the biggest RIA firms are using independent trust companies, and you want to be ahead of that curve and just know who I need to call if and when I need to. Whoever it is, just make sure you're being proactive like you are for your clients.
Yeah, absolutely. Because you never know when that $14 million trust is just going to roll up at the bake sale, right?
Well, there's a little bit of extra work that we help them through, but
yeah,
fair enough. Yeah.
Yeah, you never know. So thank you so much for being on the show. I really appreciate it. And for those listening, those links will be nearby. I'm always interested in your feedback too. So if you want to send me a message and tell me what you think, I'm always interested in improving the show. But thanks again for joining us on another episode of the Financial Advisors Want to Know podcast.